the best single venture investment, 16.5 million investments that has brought us back $2.1 billion in proceeds. So Fund 1 is 20-time multiple on invested capital. 2.7 of that is non-UiPath. So about 85% of the proceeds of Fund 1 have been UiPath. I believe UiPath went from 1 million to 100 million ARR in 21 months. At the time, that was, I think, the fastest ever.
Ready to go? Cem, I'm excited for this, dude. We first did a walk around the park and I was like, God, I wish this was recorded. So first, thank you so much for joining me.
Thank you, Harry. It's great to be here.
Now, I would love to start. How did you make your way into the world of venture first and come to where you are today? Let's just start there.
I'm a founder turned investor. I started my first company in 1999 in New York. Horribly timed, arguably the worst time in history to start a tech company. It was a company called Select Minds. We were building in social networking software, one of the earliest participants in that space, but hit the crash pretty hard. We survived, ultimately did okay, had a nice exit, and decided to move to Istanbul, which is where I grew up. I'm Turkish, born and raised in Istanbul. And initially thinking that was going to be for 2 years. When I moved back, I started meeting young Turkish tech companies, mostly consumer internet businesses, and got excited because at the time, I think I saw two things that not a lot of people agreed with me on. One is the fact that people behave similarly everywhere, especially in their interaction with technology, with consumer technology. So at the time, for example, people were telling me, people in France will never buy shoes online. And I'm thinking, I look at the US, I look at the UK, and I'm like, that's not right. People are people, they're going to buy shoes online. So I saw the playing out of consumer internet in the West and looked for opportunities to partner with companies that were trying to do the same thing in the rest of the world.
And so you're an angel in these early companies?
I was an angel in these early companies. I got very lucky. A few of my early investments turned out to be the biggest exits at the time in the Turkish market. An e-commerce company got sold to eBay. A food delivery company, the leader in Turkey, got sold to Delivery Hero. These were big outcomes, largest exits. So it started to build.
What was the multiple on your angel track?
I haven't done the math. I can get it to you later on, but it must have been about 10x overall.
So why make the transition to venture then? You're a super successful angel and you're liquid.
Great question. It was out of getting nervous because what I saw is I was able to syndicate the first couple of $1 million into these companies. But then the moment they needed anything above $5-10 million, there was nobody that targeted that stage in our region. So I'd have to come to Silicon Valley or New York or London and convince people who didn't really understand our part of the world. So I thought if I raise a fund to focus on opportunities in Eastern Europe and Turkey, then I can follow on and maybe support these companies for the couple of rounds after my initial entry. Because I thought if I couldn't do that, some of these companies might actually go bust. Mm-hmm. So it was out of fear.
You'll learn that we have these beautiful schedules and then I kind of just go off piste on them.
Sure.
But you mentioned that kind of the post $5 to $10 million, that lack of funding that was very clear to you. I think we have this huge element of tourist capital that we saw in 2021 moving to geographies which they weren't normally, and we've seen them all retract.
Correct.
Have you seen a huge retraction in cash out of your market at the A and beyond?
Of course, it happens in every cycle. They rush in and then they rush out very, very quickly. And also when they rush in, they miss out on the nuances of the region.
What nuances did they miss?
Well, the thing is, startup venture capital playbook is now visibly played out around the world. So founders know what to say. So they come and a VC that they're meeting for the first time from Silicon Valley is sitting with them in Bucharest, and they're able to tell a very, very compelling story, irrespective of what whether there's anything behind it. So I think being able to reference founders to understand where they come from, get a sense of where they go to school, which companies do they work at, like what's the environment they developed, and is there signal there? Is that what you would expect a great potential founder to be coming from? I think you get that only with immersion.
When you have damn podcasts like 20VC just give people such good storytelling. But when you actually have that explosion of capital coming into the region, a lot of tourists, prices go way up. Is that when you just sit on the sidelines and go, hey, this is a crazy time, or do you still play the game on the field?
I think our job is to play the game. I think our business structure is defined by timelines. We raise 10-year life funds. So our job is to expose our fund to the strongest opportunities in every vintage, not to try to time the market. When it's bull market, the entry prices are up. Hopefully the exit prices are up as well. So it's kind of balanced each other. But no, we felt that our job was to continue to invest.
In terms of the explosion of capital, it's tied to a statement that Doug Leone said on the show. He said venture's gone from a high-margin boutique business to a commoditized low-margin industry.
I disagree with that. I think there have been attempts to try to commoditize the early-stage market. I don't think it happens. And I think Doug Leone would be the first to agree that if it were a commodity, it would be the same thing to raise from a Sequoia or from us or from 20VC or from your dentist who's angel investing. And we all know that that's not the same thing for a founder to be. It's not cash is green and all equal. So I don't think it is getting commoditized because it's limited. It's you cannot scale it by just pouring money on it. I think that's what commoditization implies.
Does the volume and multitude of multi-stage funds having very deliberate seed strategies not mean it is a commodity? The fact that literally every multi-stage firm is seed investing. You will come out of a great Peak Games, top tier school, here's $5 million on 25 million. It's kind of like, if you tick these boxes, here's your application signed. Commoditization could be argued.
I think if you look at those firms as kind of a one strategy, one investment portfolio, I think you could come to that conclusion. But what I see it is at the core of their portfolios, if they are early stage investors. So I don't mean the later stage or crossover type investors, but if they're really early stage rooted, the way Index, Sequoia, Benchmark are, then actually, that's a great point, where Benchmark has stuck to their seed strategy. So they keep playing the game that they know they have an edge in, which is keeping fund size constant and just deploying concentrated portfolio after concentrated portfolio. The other firms decide to build essentially an asset management business adjacent to their early stage strategy. And I think that's where they start to look like commoditized products, but I don't think they are.
Cem, I'm going to be honest with you. I sit in the early stage bucket with you, and in that kind of hopefully artisan boutique business. Honestly, founders want quick cash at a good price and generally don't want someone to be involved too much, is what I see. And the multi-stage funds are producing harder and harder competition for me and for other seed players because they say, we'll give you a higher price than Cem or Harry will, we'll give you more money, and we'll leave you alone.
I think it looks at it depends on the contract that the founder is looking for. If they're wanting cash and they want to turn around and run their business, I think what you're saying might be right. Most of the best founders we partner with are looking for a contract where they try to align with co-founder-like partners to be on the journey with them. And in that case, I think they start asking themselves the right questions. And that's why for some of the top founders, you'll see out there that their cap tables are not filled with only the sort of very large multi-stage firms. They pick their investors as people. They almost pick them as if they pick co-founders.
Will you play the game? And what I mean by that is it's a 5 on 25 with a great operator coming out of a great Peak Games, or you name your kind of great outcome. Will you say, hey, we're going to go head to head with Index and try and win that round, or that's not a round for us?
No, we'll if we think this is a founder that we can align with, and if we feel that chemistry with the founder, if we see that the founder also understands us and can understand what we bring to the table, absolutely. And we've gone into situations like that where the founder ended up choosing us over some of the brand names you're bringing up.
How do you feel about price?
I think is it Scott Fitzgerald who said that like a sign of a great intellect is the ability to hold contradictory beliefs at the same time. Yeah. On the one hand, we look at our biggest outcomes and we do an analysis of what would have happened, what the return would look like if we paid twice as much at the first check. And the answer is that it doesn't really matter that much. For UiPath, if we'd done the seed round at twice the valuation, it wouldn't have really made any difference. It would have still been a fantastic outcome.
It would, but it would have halved your multiples.
Yes, but in that case, I mean, when you're at the type of multiples we're at, I mean, that's a 16.5 million investments that has brought us back $2.1 billion in proceeds. So yes, I'll take half of that any day.
16.5 brought back 2.1.
Yes, and that's after the sell-off. So it wasn't even the high water mark.
Wow.
It's power law in action, and it's actually a very humbling experience to see, because it shows you, where you have to play a very disciplined game, but you also need to get lucky.
Can I be unfair and ask, how much have all your other gains been? If that's 2.1 billion.
So Fund 1 is a 20-time multiple on invested capital. 2.7 of that is non-UiPath. So about 85% of the proceeds of Fund 1 have been UiPath. Wow. But if you take it out, it's still a 2.7 times fund in Fund 1.
Which is a very good fund.
Yes. I think it would make it a top quartile.
Wow, that's amazing. Okay, so like two opposing thoughts at the same time.
Yes, so on the one hand, we know that valuation doesn't matter. On the other hand, we cannot operate like that. So we also, as a firm, we are ultimately tethered to some idea of value, and what are we paying for, and does the company we're looking at warrant that? So I think we try to not lose on price, but constantly question us about is this entry price a fair price that we're coming in, or are we now at a point in the cycle, or is this firm just getting is this round getting so competitive that the term sheet is getting bid up, and we've passed on price in the past, and I think we have a mixed track record on whether that was the right decision or not.
What did you not do with the benefit of hindsight you wish you had done, and what did that teach you?
We've lost, we didn't understand a few businesses. I mean, one example that's probably our biggest loss is we met Bolt, the car hailing company, and they were called Taxify at the time, a small Baltics ride-hailing company. And even though Marcus, the founder, was extraordinary, we really couldn't see the trajectory to be a global leader in that space. We also had question marks about take rates, warranted take rates for an app where you just signal your location. We felt that what Uber was establishing as the market pricing wouldn't really warrant that take rate. So we had question marks about the market as well. So there, what would I have done differently is maybe been more open-minded about what the ultimate margin structure of the business would look like.
What round was this?
That was their seed round.
Respectfully, the margin structure of their seed round, or the margin structure of their business, the take rate that they have, who cares?
No, of course. If I'd been able to see that they'd be a global contender, of course it wouldn't have mattered. But they were just a little Baltics player in ride-hailing.
So I mean, I can trump you every day of the week on the biggest loss. I turned down Deal and Vanta at pre-seed, and I did both the times because I knew the founders were amazing, but I just didn't like the business. I didn't like the category. Something else other than the founder. And so now I have this, and I'm kind of intrigued to hear your thoughts because you're much wiser than me. I just have this obsession on founder, and I don't care what they do. If they're an amazing founder, they get a check from me. How do you prioritize the stack between founder, market, and traction?
In that order, founder number one, because ultimately at our stage, I think it's the only thing that matters. We've seen great starts get bungled badly because of founder problems, character problems, ethical problems, values. So the founder trumps all. We've passed on a few very interesting, promising companies because we just could not see ourselves partner with the founder across the table. Secondly would be market, because everything we do ultimately needs to be able to return our fund if all goes well. We're in a sort of a high return business by taking high risk. So the high return should be there. So if it's a small market, if it's a crowded market will pass. The traction at our stages tells us something in some cases, but it's a distant third.
Can I ask, on the it needs to return the fund, I agree, and I take the same approach. Do you scenario plan on outcome sizing and where you think that would be?
We do, but then in hindsight, sometimes we do the, post-exit, we look at our early memos and we laugh about it. Again, for example, in the case of UiPath, we thought it could return the fund. It has returned 12.5 times the fund already. So that's been very miscalculated analysis. But we do it. It's a part of the discipline of just making sure that the market's there.
So when we go back to the kind of cottage industry like vibe that we both sit in, and then also the multi-stage asset class vibe that is also there, founders have a choice. What do you advise founders who are sitting looking at these two very different products, contemplating raising a seed round?
I think the word we end up coming to is care. When you are a small partnership, in our firm, for every fund, each partner writes about 4 or 5 checks per fund. So in kind of each vintage, each year, we're talking about 1 or 2 investments at most. So in terms of the capacity, attention, and care that founder stands to receive from that from that partner is probably very distinct from what you would see at a firm with a much broader portfolio and turnover of personnel. We've had very, very low turnover.
Do you need a board seat with every check?
If it's warranted, if our check is big enough, if our space in the cap table warrants it, yes, we usually like to get a board seat, but not every time.
Will you do a single-digit ownership deal?
We will. We try not to be dogmatic. If it makes sense, if the math works. Our typical first check ownership is between 10 and 20%, but we've gone on either side of that.
Yeah, it's always a hard one. My biggest mistakes, most recently, 11 Labs in particular, is where I got like 2%, and I was like, it's just not enough. And actually, 2% would have been great in hindsight.
Yes, but then I think you should stick to principles. And we do that as well. We've passed on in some cases because of the ownership, just because we have really a certain number of bullets. We can we have only 4 or 5 investments per partner per fund.
How many companies per fund?
Fund 1 had only 15. But I'd say that's probably extraordinarily
that is super
narrow.
Concentrated.
Yes. Fund 2 had 18.
And this is seed?
Seed and A.
Okay.
And we've done selective pre-seed and selective B round joiner checks as well from both funds.
Are the B round joiner checks good?
Fund 1, we have one of them. We'll make money from it. It's not the strong performance driver for the fund. But again, if that company goes into a $1 billion outcome, which it might, then it won't return the fund, but it'll carry its weight.
A lot of founders hear from us that signaling is very real and the dangers of it. Do you think signaling does exist, or do you think it doesn't?
I think signaling does exist very strongly, and we try to, in every investment we make, we really try to analyze the signals we're getting from the cap table, from really everyone, and how they're behaving, how they're voting with their shares, not literally, but their follow-on decisions, lack thereof. I think they provide lots of interesting insight.
What are the biggest reasons for you, from your experience, companies don't scale efficiently? From 0 to 1, from seed to A, raise a great A round. What are the biggest commonalities and why they don't?
I think the biggest impediment to that scale for some companies is assuming product market fit prematurely and being tempted into going into hyperscale mode prematurely.
Why do they assume it prematurely? Do they have the wrong data? Do they have the wrong objective? Do they just believe the hype? What is it?
I think it's a combination of all the three you mentioned. First of all, ours is an industry that fetishizes growth. And as you know, the easiest metric to grow for a founder is headcount. And it creates this sort of perverse validation sense. They've just raised a large round very successfully. They have the budget. they put out the ads, they hire the recruiters, and off to the races they go. And of course, when you're especially on the go-to-market side, if you're scaling your go-to-market team, then you give them a script and they start working off that script. If that script is not a perfect fit for where that company is at the moment, then the sideways trailing starts to happen. And losing the ability to adapt and iterate, especially on the go-to-market side, is what we've seen as the biggest cause of that kind of sideways trailing off.
When that sideways trailing off happens, do you communicate that super clearly to the founder? And how do you think about when enough time is? You don't want to be jumping in too fast. You don't want to be too negative too soon. How do you think about that?
Correct. First of all, we believe in being quiet on the board, and it's a skill that we have spent a lot of time thinking about, and also through our kind of apprenticeship model internally, we try to distribute within the firm.
Why?
Because first of all, I mean, we're the only asset class where the asset chooses the investor, right? So there's this enormous pressure to demonstrate value add, and what this means is, and social media unfortunately compounds this, that there's this temptation for VCs to be coming up with aphorisms around, what a company story should look like. Whereas every company is unique, every company has its own pace, its own trajectory, and we think that you of course learn from your experiences in other journeys, but then synthesize that and distill that to very carefully chosen moments to provide input to the founder. I think your job as a board member is to understand the company, be very well prepared on any interaction like the board meetings, etc. We're obsessive about preparing for board meetings, but we are very careful in choosing when we share strong opinions.
So I'd love your advice then. When I have tough topics that naturally come up in a board meeting, I'm always torn in two ways. One, I should air my thoughts and opinions and concerns because Cem might have something important to add, someone else might have something important to add, and it might be a valuable exchange of perspectives. But then also, caveat that with, it's also a sensitive topic. It's maybe personal towards the founder that it might be a criticism in a bad way. And I want to be just respectful of not throwing them under the bus, so to speak. How do you balance between the two?
First of all, I think the board dynamic a healthy board dynamic is one where with all the board members around the table, but also in one-on-one conversations with the founders as well. So I think it's very difficult to have that conversation come up for the first time in a board setting. If it's sensitive like that, I think the valuable relationship with the founder that the board member or the VC has should allow for a better introduction, better timing, etc. for that sensitive topic. But I think beyond that, again, as long as you're choosing what important few topics are carefully, then bringing them up should not be a problem.
You said most investors have lost the skill of being quiet. My pushback on that is we sell the most obvious commodity of all, which is cash. Yours is the same as mine, and mine needs to be greener than yours. And so we are marketing, and we are a marketing machine as an asset class. Is that not understandable?
I disagree with that. I think what we sell is not our cash. The cash is available. It's the seed and A rounds are flush with new capital coming in all the time. So I think that what we sell is our time and attention and capacity. And we're selling one of those 20 slots in that fund's portfolio that I'm going to be devoting my entire set of resources for the next 10 years. That's what I'm selling.
Do you think the best founders really need their investor?
The best founders need a group of smart, aligned individuals that they know are on their side and pushing in the same direction, rowing in the same direction as they are when they're trying to create this miracle called a successful startup. Because I think every successful startup is a miracle. They shouldn't happen.
Do you think the boards that you're on are valuable to the founder?
I hope so.
Not you, but the boards.
I hope so. I mean, we've seen board dynamics where, alluding to what I was saying a minute ago, there's just so much pressure to demonstrate value add that we find some board members just get overly eager to contribute, to add, to maybe even iterate over and over topics that maybe don't warrant it. But I think it's important to understand that, first of all, the founder always knows their business better than us. A lot of times they're smarter than us. They're certainly harder working than us. They have more skin in the game with us. So our job is to just support them when we can and when they need us.
How do you advise founders on the valuation they raise that early? I'm sorry for this being an off-field question. I was literally just going through it. And I said to the founder, raise at a valuation you feel incredibly confident you can raise at 3x the price of on the next round. It's a good heuristic.
I think for practical reasons, that's a good benchmark. Whether it's 2, 2.5, or 3, that could be discussed based on the stage. But more or less, I think that's a good heuristic, a good rule of thumb. What we try to align with our founders is the early rounds are not real rounds. They are contracts where you're demonstrating alignment around a target that is very far out ahead. I mean, every early stage check, you're buying a very out-of-the-money call option on these businesses. So it's not a trade. I think a lot of people get that wrong. It's not a trade. It's really a construct for an alignment, for a partnership, where the founder is saying, you know what, I'm going to have a few people around this table on this journey with me. And what I'm saying in return is, this company and your team, the founder team, is going to be one of my 4 or 5 slots for this fund. So for the next 5 years, I'm all in with you on this. I think the early stage, the seed round, A round, is really a contract that establishes this alignment. It's not a real investment. It's not the same as buying Apple shares in the market.
What are the biggest ways that founders and VCs become misaligned?
I think, we usually try to sort of disagree with the founders in the term sheet process at least once, so that we kind of see the dynamics of what happens around that. But so usually what we see companies sort of go in a wrong direction and board dynamics go in a wrong direction is if there was a lot of tension in the early round discussions, if this was a very contentious negotiation around specific governance terms, etc., sometimes that leaves a bad taste in the mouth on both sides. And there's this lack of trust that is in place as soon as the investment is done. We've had very few cases of this, but it's a very negative environment to operate in.
A lot of founders are told, run an efficient process. Make sure that you align meetings, this week's first meetings, this week's second meetings, this week's term sheets. Do you mind feeling part of a very manufactured process?
If we feel rushed, we mind. And we will not get rushed into decisions. In 2021, when the market was in a frenzy, we would never categorically pass on a valuation. So we've written very expensive checks in that period, but we would categorically pass on not having enough time to understand the business and digest the opportunity. And sometimes the process that gets communicated to us will not let us understand and digest a company. In those cases, we'll pass. And it doesn't feel good because categorically passing is not right. And I'm sure there's probably some good companies in there we may have passed on because it felt rushed.
Can I ask, the expensive checks that you wrote, have they matured into great companies? And the real question I'm asking is, do high prices lead to high quality?
The jury's out on the entire set. A few of them, a few very critical ones, have matured into and have now grown into the multiples that we ended up paying for them at the time. A few others are still on their way there. And it's a young portfolio, so I can't really.
It's interesting. The worst performing segment of our seed portfolio on our Fund 1 was 5 on 25 because they had too much money too soon. There was a lack of focus, a lack of urgency. And actually, they struggled to raise their next round because it was already at too high a price for the round that they were going to go and raise.
Right.
I thought that was an interesting analysis.
I think one difficulty in sort of analyzing our track record and mistakes is the round parameters have become quite fungible. You know, what's called a pre-seed, what's called a seed, what's called an A are a bit all over the place.
Sure.
I mean, last week was the announcement of a seed round, $100 million seed round at $1 billion valuation. So that's not really a seed. That's a unique case. That's something else, but it's not a seed round. So
do you agree we've seen the eradication of pre-seed rounds? I never see pre-seeds.
To us, pre-seed is that there's nothing to look at. That's what we call a pre-seed.
Okay. So I'm looking at one now, which is $5 million for the round. I'd do $4 million. But there's nothing. There's two people just with an idea.
So, okay, that sounds like a very big seed round. I'm sorry, very big pre-seed round if there's nothing to look at.
Would you do that?
If we're sold on the founders and the markets, since there is no traction, we can't look at that.
Do you find it hard to get comfortable? I'm finding it hard to get comfortable in this situation, honestly, Cem, which is like, I get it. They're great. They come from great companies. They're mature product leaders. But it's $4 million on nothing.
It's our job to be uncomfortable because we're writing very high-risk checks that should lead to high return. So, but high risk always feels uncomfortable. So I think it's normal to feel uncomfortable.
Has
I
it
think
got
that
easier over time for you?
No, it hasn't. It hasn't. No,
Bugger.
venture investing is never easy. No, it's. I think it's a very hard profession.
What's the hardest thing that people don't often see, do you think?
How long things take. And I'm saying this as a very fortunate VC that, you know, the big performer in our first fund, matured very, very rapidly. But things take long.
I think one thing that I think about a lot is wealth and how that impacts on investor mindset. Does the fact that you are now incredibly wealthy make you a better investor? In other words, are richer investors better because they only see upside? You did very well from your angel portfolio and from being an entrepreneur before. Do you think richer investors are more successful?
I think it should help with that risk equation. We think a lot about GP commitment size. We have a very high GP commitment in the fund, and
what is it?
It's close to 10% of a $250 million fund.
Fuck.
And we were very proud of this, saying that, look, this shows our confidence in what we're doing, and it gets us aligned with our LPs. A very experienced LP challenged me on that and said, wait a minute, I don't like that. I have, what I'm allocating to your fund is the highest return, but the highest risk part of my portfolio. So I don't want your team nervous because you personally have a lot of money in this fund. I want you to take very, very high risk investments as long as the return is there. Will this high GP commitment make you nervous, make you more risk averse? I thought that was a brilliant challenge, brilliant question. So I think it kind of plays out on both sides.
I also think GP commits are actually flawed in many ways because a lot of people will say, with total respect, look at me and look at you, and our GP commit is 1%,
right?
But it's just me, and it's the start of my career,
right? And
I don't have the liquidity that
right.
You've done very well with. And they go, well, other funds have much larger, and it's so much about proportionality.
Of course, and if an LP can't see that, shame on them. I think that's inexcusable to hold a young emerging manager to that hurdle. I mean, without my first fund outcome, I wouldn't be able to put the large GP commitment in Fund 3.
Totally. Have you seen institutional American LPs come to your region en masse and allocate, or has it still been a gray area for them?
It's too exotic for most traditional allocators to VC funds. So our LP base is very diverse, but it's not concentrated in large North American institutions.
What should they know that they don't know?
They should know that I think venture capital has made the mistake of following private equity in terms of LP allocation categorization. And in private equity, regional investment strategy ultimately is exposed to the regional macro dynamics. Whereas in venture capital, because the outcomes are typically global outcomes, you may be hunting in a region with certain macro dynamics, but the outcomes are never impacted by the macro. My portfolio is a global portfolio. My outcomes are American outcomes, London Stock Exchange outcomes, acquisitions by global tech companies. They're not outcomes that are subject to the turbulence of whatever, country that founder team may be coming from.
How do you respond to an LP who goes, there's political risk, there's currency risk? Oh, building a business is hard enough.
We go to our track record and show them that there was not a single case where any of our portfolio companies were impacted by those risks. When bad things happen to our portfolio companies, they're the same bad things that can happen to a Silicon Valley-based company.
When you lose a deal, why do you lose the deal?
Sometimes on price. Ultimately, we have to underwrite to a certain level of return. I always feel that there are venture investors out there with a very much lower cost of capital than us. So somebody will come and underwrite the same opportunity to a lower outcome. In those cases, our offer ends up being not high enough. So we've lost on price. Sometimes we've lost on ownership, desired ownership, where we find the existing investors would not let a new lead investor get to the level of ownership that they would like to get. Those have been some cases.
We mentioned turning 16.5 into 2.1 billion. I do want to discuss that. I spoke to Daniel before the show. I think it's probably one of the greatest venture deals in European venture history.
Probably the best single venture investment.
That's a pretty good intro to the show, isn't it? I mean, let's be honest. So I wanted to start on that. How did you meet Daniel for the first time?
So Daniel had been building a company called Deskover, I think since 2005 or 2006. It was more of a consulting firm that was doing custom automation and different sort of back office applications for different workflows for various clients. We met him in Bucharest. I think the company was 12 people when we met him. And he struck us as being at the right place where, here's a founder who was deeply immersed in the problems that his clients were facing on a day-to-day basis. Very technical, so had a very strong vision on the immediate problem he wanted to solve. He didn't start out with painting an ultimate picture of what UiPath would look like 10 years out as a large global enterprise software company, but he was very keenly focused on what is the next feature he would need to add and how long that would take and what would that solve at what customer or what new customer would that then allow him to sign. So very pragmatic, very iteration focused, very technical, very hands-on. He also wowed us on how he saw what he was building to be so applicable in so many diverse situations. And he came and convinced us that at one point, every single company in the world could be his customer.
Was he immediately exceptional, being honest?
In these regards that I talked about, yes. Now, what we were worried about when we first met him, and we spent a lot of time with him, we met him in 2014. We ultimately wrote the first check in 2015. So we had maybe 6 to 9 months that we were able to spend with him and the team. One concern we had was, is he a go-to-market leader? And because our Eastern European rooted founders are not polished, his English wasn't fluent. He was not a great narrative storyteller at the time. Can he be the sales leader here? We introduced him to a few either sort of early hires or potential co-founders to kind of join him with sort of very senior responsibility in the company. But along the way he interacted with them, one, we saw how earnest he was and how much he wanted to make this happen. So he was giving these people the time, the effort to try to see if they would work. In the process, we got convinced that no, Daniel will be able to handle all the responsibilities of a leader and a founder of the company. So we didn't insist on this go-to-market question being fully answered at the time. But he didn't fit the enterprise software founder mold.
So when you finally build that conviction to go, you know what, we want to back Daniel and we want to do this. What did the deal look like?
He was raising $1.5 million. Initially, we thought we should do the full $1.5 million. I mean, this is a $150 million fund. We would have been able to write that check. But then we thought this is a big enough vision that this company also, I mean, at the time he was struggling to raise. We showed the company at that first seed round, we showed it to 14 funds to co-invest with us. Credo ultimately came in with a $500,000 check. We led with $1 million, and then Seedcamp joined us with a $100,000 check. So it was 1.6 million raised. I believe it was just south of 7 million pre. So that was the initial round.
7 million pre.
This is a company doing about half a million in revenues.
The amazing thing is we had Daniel on the show, and it took 9 years to get to that stage.
Yes. Although, I mean, it's not the same business. I mean, he started out as more of a solutions provider and then ended up finding the product idea along the way and building a product.
With respect, it's a $150 million fund. Doing a $1.5 million check is a 1% check.
Correct.
Why didn't you?
Because, the most you can invest out of a $150 million fund is $15-20 million. And we know that it costs more than that to build a global software company. And again, this looked so off the beaten path, London-based or New York-based growth fund to come and invest into. We thought we may have to support the company. In fact, probably about a year and a half later, we ended up then showing the company to about 40 firms. Everybody passed. I think every single European VC has passed on UiPath at least once. So we had to bridge the company by ourselves. I mean, not by ourselves. Our co-investors came in as well.
Was it doing well?
It was headed in the right direction. The numbers were not exceptional, but we could see how the clients were getting value out of the product. It was certainly headed in the right direction, and that's what our reserves are for. Our reserves are for those companies that will be misunderstood by the market or overlooked by the market because they don't fit into the mold. And so we were able to write that check with conviction.
Sorry, that's too good. Okay, so we have this kind of tweener round.
Yes.
And I spoke to Daniel, and he said you proposed to the deal at 20, and he would have taken 25.
Yes, and we couldn't agree.
He said about this 3 times. It's one that he clearly remembers.
Yes.
What I love about Daniel, like even with the success, he still remembers this.
Yes. So there's a learning from there. Like when the numbers are pointed in the right direction, double down, go and do the price round. We felt that the feedback from the market was so poor that nobody else was interested.
What was the feedback?
The feedback was, okay, yeah, keep us posted. This is not enough traction for us to care at the moment.
Okay.
And this is coming from
40
a
firms.
very large number of firms.
Okay, and so we get that feedback.
Right. So we then we agree on a convertible structure. I think ultimately it converted at something in the $60 million range because the A was at 80, I believe. But so we did the convertible. We then regretted the price. But of course, I mean, from that point, when the numbers start to show, then the picture changed 180 degrees.
When
all of a sudden, everybody was
How much did you do in the convertible?
2.5.
So you do 2.5 in the convertible.
So we did 1 in the seed round, 2.5 in the bridge round, and then we put in $3 million at the A round. We introduced them to Excel.
What changed in that business?
The numbers, the traction numbers. Essentially, all of a sudden, the proof was out there for everyone to see. In that case, everybody got it. It clicked. Lots of interest. Everybody wanted a piece of the company. Excel came in and led the A round. We joined, and they raised at that $80 million valuation, and then about a year and a half later, or 2 years later, then Rich Wong at Excel Growth came and led the B round at $1 billion valuation.
Did you do more at the billion?
Yes, we did. We wrote a $10 million late check with our hands shaking at the time. But again,
that's a bold check.
Yes, that's actually. I mean, this is the way we ended up continuing to invest into what looked like a very strong performer in our hands. That's why we raised the size of fund we raise.
At $1 billion, that's a tough one to underwrite.
Right.
How did you think about that?
The trajectory. Just the trajectory and the fact that there were a few things in place. One, we saw what happened in Japan. Japan was a very important early market for UiPath, and the Japanese uptake was very, very fast. So we could see that when the market conditions are right, back office clerical work in Japan is hard to fill by enterprises there because of the demographic reasons. So, but we could see, if one market behaves like that, we could see this in other markets as well. So the revenue trajectory at the company, I believe UiPath went from $1 million to 100 million ARR in 21 months. At the time, that was, I think, the fastest ever for a company to have grown that fast. So we could see early signs of this trajectory.
That is insane. My question to you is, you said reserves are for the overlooked. When they get money from Excel and then Excel growth at the prices they do with the brands that they do, this isn't overlooked.
Correct. At that point, no. This is more, let's ride that big momentum that we have.
At what stage do you think, actually, I'm no longer getting paid for the risk that I'm taking, and I could put this into 3 more new companies?
No, that was an internal question for us. At that $1 billion valuation, we ended up deciding to write that 10 million, and that turned out to be the right decision, but it was not a fast decision for us. Then when Sequoia led the $3 billion next round, we sat it out. We did not participate. And then when the 7 billion valuation Series C happened, was it C or D? I can't remember. But then we started to carefully divest. This had been such a big win for us in terms of returns. Our kind of prudent investor responsibility to our LPs would be to then try to start to realize some of these gains.
100%. Very wise. I think we've taught a generation of investors that it's all about leaning in, and actually the best, we have a huge amount of data on this, but the best lean out strategically over time. How much do you sell in those increments?
It was
percent-wise?
In each case, it was between probably 1 and 10% of our holding. I don't think we ever went up as high as 10%.
Is there a kind of strategic thought process behind how much you sell?
It's an analysis at the time of what our holding of that asset, that company looks like at the time. And we try to just triangulate to the price we may be able to sell at. Our secondaries were all at a premium to the primary round. So each round was so oversubscribed that we were able to actually sell at a premium our share class, shares that are at a lower class on the liquidation stack.
What did the subsequent sell down look like?
We ended up, I think our high watermark ownership was 18% in the company, and we entered the IPO slightly below 10%. So we sold about, I can't remember the dilution effect on that, but we were still the largest shareholder going into the IPO in the company. But we had also realized, already, I think 3-4 times the fund at that point.
And then you just sell down 10% a year for the remaining 5 years?
Post-IPO?
Yeah.
Post-IPO, we executed a divestment structure that was faster than that. Of course, we didn't want to impact the price of the shares. But once the stock is public, we felt that we have lost our entire edge in trying to manage that investment. And I think as early stage investors, our job is to then leave that decision to our LPs. We were able to distribute in kind to our LPs who prefer to receive shares as opposed to cash.
Hard question. When the firm does so well, it is, as you said, probably the greatest venture investment in European history. There's a concern of actually people just don't need to be here anymore. People can go and be an angel. They can stop venture. It's a very big concern for a lot of firms who are very successful. How did you think about that problem?
I think it's a very personal question, a personal decision. You're absolutely right. But for us, I I understand that my team wants to work for a firm that one day they will inherit. And I want this to be bigger than me, that this is around for decades, if not longer. And when I look at the best, most inspirational venture firms out there, I see that the ones that have done the best are the ones who are able to create that institutionalization, and that doesn't happen with your family office.
You said you lost your edge when it went public in terms of what you know and how you act. There are firms which feel that actually they are best placed to manage positions because of asymmetric information. We've known Daniel for years, we know the market, we know all these things public market doesn't, so we should manage that. Why do you feel you've lost edge when companies go public and they don't?
In our opinion, tech sector moves too fast for your edge to remain. It decays. Your whatever insight or asymmetric information you have until the point of the IPO starts to decay. If you're still on the board, if you're still an insider in the company, then your ability to manage that position is diminished, right? I mean, then you're essentially like a founder long term, and our funds have a very specific lifetime. So, even if I wanted to hang on to my stake, it would only post IPO. It would only for a few years, because then we have to divest anyway. Because structurally.
Speaking of structurally, you said there about kind of the hardest thing that most people don't know is the length of time it takes to achieve liquidity. Do you think venture structures need to change?
I'd love for them to change. I think a 10-year life for a seed and A focused fund is too short. This is evidenced by the fact that I don't know a single early stage VC fund that was liquid by year 10. And is there extensions, etc. But it's also probably a healthy pressure and friction to put on a GP team so that they're actually thinking about liquidity as they approach that 10-year mark, even though there's perhaps understanding implicitly around the table with all the investors that it'll probably not be fully liquid by the end of fund life, as defined by the first LPA.
Is there anything with the UiPath process where you look back now and you're like, I wish we'd done that differently?
In hindsight, we should have participated in that $3 billion round by Sequoia. We post IPO, we did some block trades that felt again that as if we were playing in a market that we're not naturally suited for. So maybe the divestment strategy post IPO would have been a bit different.
16 to 2.1, amazing. Sadly, it's not all that. There is sometimes a loss.
Of course.
What's been your biggest loss, and how did it change you as an investor?
Fortunately, we haven't had big losses. I don't think we've lost the number that you mentioned in a single investment, and we've had relatively low loss ratios, which is maybe even a criticism.
What is a low loss ratio?
In fund 1 out of 15 investments, only 3 of them did not return capital for us. Now, 6 companies are still live, but we expect to make money from all 6 of them. So they will not be loss-making. So we will have made a positive return on 12 out of 15 investments in Fund 1. Now, when I think about it, some of those returns were capped returns. They were probably lower risk investments than we should have made, even though they returned us capital. They probably cost us 2 higher risk, higher return opportunities we should have probably backed. That was a learning for us from Fund 1.
Do you think about downside protection when investing?
I do, because I was an angel investor before, or maybe I'm human. Because I know I shouldn't be thinking about downside protection, but it enters the thought process. It enters the equation. I think it's overrated.
Why?
As I mentioned before, our deals, our investments are not real investments the way you go buy Apple shares on the stock market. They are long-term contracts around a vision, and ultimately, it doesn't really move the needle that much whether you have a liquidation preference that can lock in some asymmetric returns if things go bad. Many times we've seen those type of structures get renegotiated at the point of liquidity because it just serves one right purpose or another. Again, we've never really seen downside protection measures make a big difference in any outcome.
What has been your biggest loss?
Realized loss has been about 6 million in a company that was faced with some regulatory. It was an HR business that faced some regulatory issues around it, and laws changed that made their vision very difficult to execute, and they ended up liquidating.
Did that impact your mindset moving forwards in any way?
In that case, we had written a follow-on check where I think about that follow-on check that we maybe didn't have enough data to evaluate that follow-on check. So that could have been a smaller loss. I think there's a bit of learning there. That was an early investment of ours in our first fund. So I think we were still somewhat novice around fund management and fund investing as opposed to personal investing. So the learning is around maybe diligencing a follow-on investment more thoroughly.
How do you approach the diligencing of follow-on investments today?
Depends on the follow-on investment. I think it's different when you've written a $500,000 check and you're writing another $500,000 check early on in a journey, whereas you're really doubling down with a 10 million UiPath late check. So it's
like 0.9, they have the rule, which is like, you know what? If a great fund does your next round, we'll do it too.
Of course, that's a very strong signal, but we've done, the bridge round at UiPath, no great fund was touching the company, and we had to build our conviction internally. I think if you have the luxury to get validated the way you mentioned, of course.
Final one for you. Are you worried by liquidity markets today? We've seen M&A markets close up. A lot of competition prohibits M&A happening today. We've seen IPO markets, almost shut down entirely. Are you worried about that?
If it's a sustaining trend, I am. I suspect it's not. I think markets are cyclical. I think, exuberance will come back. We've started the rates change direction recently. We'll see what the FTC governance will look like post-election. So I think those are cyclical. I think it'll come back. Great companies are defined by sustainability, that they're not dependent on the mood of the markets. Again, the outcomes are very dependent on the vintage. I think a very humbling fact is the biggest predictor of a fund's performance is its vintage. So, irrespective of how.
Do we all get a pass for last vintage?
Depends on how you played it. I don't think you get an automatic pass. I think, the question rightfully that will get asked would be, what did you say you would do? Did you do what you said? If there is a performance issue, can it be attributed to the markets, or was it other factors that led to it? If it's pure vintage related, I think again, it's not a coincidence that funds get benchmarked based on vintage.
The majority of funds from 21 will not do 1x. Agree or disagree?
I haven't seen the underlying data. I would suspect that is probably the case. I'm afraid that is a right prediction.
I'm really worried actually about now. It's a really hard time to be investing, Cem, I feel. Pricing is insane. The AI bubble is just almost more prolific than 2021 from my perspective. Do you agree with me, and do you share my concern?
I agree. Is it more difficult than it's ever been? I'm not sure. I think in these kind of in-between cycles situations, I think things get a bit more murky. That's why it's important to have clear strategy. It's like, what's the game you're playing? What do you think your edge is there? Are you sticking to that game? I think that delivers. That gives me confidence.
I agree. Do you play the game on the field for AI companies, or do you just say this is a bubble right now?
Everything that touches software today is AI. There is no software company that doesn't utilize machine learning and artificial intelligence in some way to do their job better. So, of course, every investment we've made out of Fund 3, the last 5 investments, are all in one way or another AI companies. Now, are we investing into hundreds of millions of dollars rounds of foundational models? We're not. We're not in that.
Come on, Cem. It's only 100 billion. Did you see that Larry Ellison on stage? He's like, it costs $100 billion to enter the race.
Yes.
I saw it at like 1 a.m.
Well, he'd like that to be the case, because then there's only 4 players in that game, right?
Yeah, I mean,
I'm not sure that's the game.
Listen, I want to move into a quick fire. So I say a short statement, you give me your immediate thoughts. What do you believe that most around you disbelieve?
I think I alluded to this, but I believe that most people believe wrongly that an early stage investment is a trade. You're buying something for you're buying a share for a price. I believe it's a contract for long-term alignment to build a great company.
Which venture investor do you most respect and learn from outside of your own firm?
Fred Wilson was the first person to tell me that he thought I might make a good venture investor. This is back in 2005 when I just sold my company.
Did he say why?
He thought I was well-rounded. And he's been an inspiration and a source of learning for me, like through his writing online as I developed into an investor. I also have a lot of respect for USV and Benchmark in how they've kept their discipline around what they think they do better than anyone else. And I think the results show. So those are the 2 firms I would name.
Most memorable first founder meeting?
One of our Fund 2 founders I met when he was 6 years old. And I picked him for my soccer team.
How old was he when you funded him? 12?
No, he's about 42, I think, when we founded him.
Wow, that's amazing. Okay, I did not know that one. Tell me, what's the most contrarian or unorthodox advice for founders listening?
Founders usually underestimate the leverage they have on their cap table. They negotiate things for very obscure situations, etc. I think experienced founders know that it's their company, and they will have a lot of flexibility around managing things when it happens, when the opportunity comes down the road. So I always find myself smiling when we're negotiating a very sort of obscure one-off far-fetched scenario where I just know in my actual portfolio, I know how much weight the founder carries. And it's their company, it's kind of funny.
What do founders most care about in the term sheet that they shouldn't?
I think it goes to my last answer is, for the founder, I think the most important thing is probability of success. Is this round that I'm closing, is this going to impact my potential of getting where I want to get to? As a percentage, will it make up for the dilution I'm suffering? So if I'm giving up 20% in this round, after this is signed, am I 20% more likely to get to that vision? If the answer is yes, then they should sign.
Have we seen predatory terms come back in the departure of tourist capital?
Very rarely. We've seen a few, but usually they're in essentially very, very difficult situations. So I doubt there will be any good outcomes coming from those dirty terms.
What concerns you most in the world today?
Technology has been a factor in concentrating resources in the hands of very few. And I think that is causing a lot of problems right now. And I think it's going to get worse before it gets better.
Is there any way that can be solving that? Is that not by nature just capitalism and innovation that is?
I'm hoping, with the existential threats that our world and humanity faces, I think, solutions that are compatible with capitalism or how resources get allocated will also emerge. However, in the short term, technology has been a very strong accelerator of the trend.
What do you know now that you wish you'd known when you got into venture?
That things take long, so I should be patient.
Final one. What question are you not ever asked that you should be asked more?
I'm surprised founders don't ask us about data around our follow-ons. I think, at the seed stage, early stages, I think that's an important, when I mentioned that founders are buying care by investors, that's actually a very good indicator of care.
Cem, listen, I'm so appreciative of you doing this. As I said, I walked around the park and I was like, I really wish that we were doing this as a show. So I'm so grateful that you did this, and thank you for joining me.
Thank you for having me. I've been a fan of yours for a long time. It's fantastic to be here. Thank you.